Massive amount of Fed repricing we've seen in the last 24 hours or so. Given just the inflation concerns out there, what does this all mean for risk assets, you think? Are we expecting more pain to come?
Well, I think in the short term, we have to expect a little bit more pain. Clearly the market was expecting peak inflation and has now had to delay that for some time.
I mean, how do you look at the whole inflation picture, though? I mean, if we're talking about 8% in the U.S., you have food inflation here in Asia, very much closely watched. How does that affect margins to you, corporate earnings for the quarter and the rest of the year?
Yeah, that's going to be a very big question over the next sort of 6 months or so. The companies that have the ability to pass on, this increasing inflation, and that's going to have a huge impact on earnings, and that's going to become a lot more of a focus.
So what's it going to be for the Fed then? I wonder, is it more about a fight against inflation and they have to get it back to target? Or are they going to have to compromise in some way to avoid some kind of recession scenario now? How do you see this all being played out?
Yeah, I think it's going to be very tough. I think clearly in the short term, central banks, we saw over the last sort of month with the RBI and with the RBA are trying to get ahead of the curve. They want to be seen to being in control of the narrative, in the near term. I think longer term, it's going to be much more of what's happening in places like Russia. Clearly energy and commodity prices have caused quite a big spike. Now, the longer that lasts, the more it starts going into other aspects of the economy. It starts getting reflected in wage expectations, and that's when this whole transitory element starts to drop off and it becomes a little bit more permanent, and then that sort of the R star or the sort of long-term interest rate may start to change, and that has larger impacts.
Is Asia still the place to kind of park your money then, and how are you looking for opportunities in this environment?
Yeah, this is an interesting sort of context. I think when people think about what's happening, you usually would have expected Asia to underperform year to date, and in fact we've seen the opposite. So we think there's a number of reasons for that. Firstly, there have been a lot slower to come out of COVID reopening, and that's a benefit that's starting to come through now. Secondly, they've been a lot more conservative on fiscal and monetary policy. So we think that's sort of being something that we're not needing to see quite the same reaction on rates.
You don't think that Asia's going to have to catch up with what the Fed and other DM central banks are doing?
Well, I think to an extent, but we're starting from a position where the real rates here are actually real rates. They're not quite as negative as what we've seen in the rest of the world. So we do think there is that element. And secondly, because of the sort of more lockdown, we haven't seen as much sort of the economy overheating as we've seen in other parts of the world. So yes, food, yes, oil is having an impact. But again, we have seen some offsets. If we look at ASEAN, for example, they're benefiting from, what is happening, in Indonesia, for example, with commodity prices.
Is China the exception then, when you look at Asia, just given that they continue on to double down on COVID zero, and any kind of news of them loosening, they kind of walk back on that anytime there is kind of any kind of cluster that you see in some of these big cities? Yeah, sure. So how's that impacting sentiment, you think?
Yeah, look, I mean, clearly the sentiment is very negative, but, so the sentiment's very negative. The valuations have come back a very, very long way. And as we know, markets will always bottom 6 or so months before the actual economy does. So the question I think people need to ask themselves at the moment is, in 6 months' time, is China going to be starting to open up from where they are on COVID at the moment? Are we more likely to see a bit more stimulus than we're seeing at the moment? And I think the answer to those questions is probably more likely yes than no. And when you combine that with the valuations at the moment, I think at the margin it's probably worth having having a good relook at China at the moment.
Where is your biggest bias now, I guess, if you look at Asia? And you mentioned about the ASEAN outlook there. There's a lot of money that's going into that. Where do you see kind of the best markets that can fare the best in this Fed tightening kind of process?
Sure. I guess if we look back 6 or 8 months ago, ASEAN, particularly Indonesia, were quite contrarian views. That's no longer the case.
Not so much, yeah.
No. But we still think they're very interesting. 681 million people in ASEAN. They've been hurt by lockdowns. They've been hurt by lack of FDI going to those markets, again, because of the lockdowns. Now we have the lockdowns coming to an end, partly because of immunizations, partly because of natural immunity. And we're seeing those economies start to kickstart. That foreign direct investment's coming back quickly. People are more than ever looking to diversify their supply chains, and the average consumer over there, when they get an extra dollar in their pocket, has a much higher propensity to spend than we see, for example, in the US market. So we still think that looks good. Outside of that, again, as I just mentioned, I think if we're looking, for a cyclical upturn in China, I think that's probably likely to come. Valuations have come down. COVID will slow down at some point, and we are likely to see some sort of stimulus coming there. And probably the last part is in Japan. Again, we've seen a very, very weak yen. There's a lot of incredibly competitive exporters there now, and the equity prices have not reacted, as well as they probably should have in that scenario.